Welcome to what promises to be a very thought-provoking and timely discussion. Today we're sitting down with our brand new friends and experts, hopefully, to explore what may well be one of the most important shifts in US real estate investment in a generation. This is different to the format of our normal webinars. For those of you who have attended before, I think most of you would have attended before. We have no slides. This is what we call the fireside chat, and we're just going to rack their brains on everything they know about industrial real estate and interfere as little as possible with the conversation. We're asking them the big question tonight. Is America's manufacturing comeback supercharged by Trump-era onshoring policies and potentially falling interest rates, creating a generational opportunity in industrial real estate? Perhaps just as intriguing for you are what are our strongest proponents of medical office, Machiel and Martin. Why are they pivoting into this sector after years of complete conviction in the healthcare space and medical office? And we're going to be very interested to get their insights into their experience since they have been looking at industrial for the last, I think now, Martin, about 6 months. With us today, and let me just introduce, first of all, Ronald Snick, co-founder and managing partner of Blueprint Partners. Ron is a seasoned industrial real estate executive with a strong track record in investing and capital structuring, formerly the CFO and operating partners of Reich Partners. He led financing and redevelopment initiatives across a wide national portfolio. Today at Blueprint Partners, Ron focuses on sourcing and executing high-conviction industrial deals. Mark Esrick, co-founder and managing partner, Blueprint Partners. Mark has spent over 4 decades in industrial real estate with a focus on sourcing, repositioning underperforming industrial assets. Before co-founding new Blueprint Partners, he was the president of Reich Brothers Real Estate Group, where he led major adaptive reuse projects and assembled industrial portfolios nationwide. And Ron, I'll tell you where I got it from. I actually got it from ChatGPT. So we made you a little bit younger there, but anyway.
I can't believe it's been 4 decades, but it's actually been slightly more than that. It's frightening.
Good. And then, of course, we've got Martin Freeman and Machiel Lucas, who you all know. And I think that we will start off with them. But before we do, I am Justin Clarke, and I am the director of the new hybrid portfolio, which is the industrial portfolio that we are going to be putting together. And of course, let's dive into the subject of the day. Just before we kick off, please note today's discussion is for information purposes only. The opinions expressed by those are those of the individuals. This is not investment advice, and we recommend you consult an independent advisor before making any investments as a result of these opinions. Finally, Orbest SA is an authorized financial services company. Rightio, so let's get into the business of the day. I'm going to bring you in, Martin. We have not acquired any medical buildings in the last 18 months. I think if you remember correctly, I think 4700 was the last building that we acquired. And it's not through lack of effort. So perhaps you can talk to us a little bit about what's going on in the medical office space, just from a high level, and why we have been out of the market for so long.
Thanks, Justin. Really great to be on the webinar today. So to kick things off, we absolutely love medical. It's proven its resilience and stability over the past 8 years. And as you know, we've been acquiring buildings across the US, and our portfolio remains 93% leased across the 9 states, which is fantastic. And so we certainly have not been out of the market. We've, in fact, been very much in the market. But over the past 18 months, the stubbornly high interest rates impacted the current market price and what we pay on buildings. And as you know, the volume of deals available in the medical niche we've spoken about before is always relatively small compared to other asset classes because the sellers of buildings are super sophisticated. We've got large portfolios, most of us, and not to mention that the competitors have got very patient, cheap capital. And so they are content on holding their deals and are not really prepared to discount them at this stage in the current environment. So to find the right deal is actually very tough, or it leads to us finding a good deal, but then it's only moderate returns for investors. And we also know that when you have to acquire these buildings, the one thing is that medical tenants are very sticky, but they also demand, and they're able to get huge tenant installation allowances and many months free rent, which you have to build in. So in summary, the medical office sector continues to generate great returns for investors, but with limited upside and difficulty to find them. At the same time, and to segue into the discussion, we've been looking at the industrial sector. It's actually longer than 6 months just, and we continue to see incredible opportunities literally every single month that can generate the same consistent, stable quarterly dividends for our investors, but with even higher overall returns.
I think let's get Machiel to jump in here, because he's spent most of his time looking at the deals and trying to underwrite the medical deals and trying to make them work. So Machiel, jump in here and tell us a little bit about how many deals you're finding that can do the 7% cash and cash and the 50% IRR that our investors are looking for. And perhaps I'm going to ask you just to finish off by talking about, you pushed back a lot initially, and then suddenly you became super enthusiastic. And I think it was literally 2 days of being on the road, going to look at various industrial buildings. So tell us about your movement across and why you became enthusiastic about the industrial sector.
Yeah, Justin, as you know, my function is really to do the acquisitions here in the United States. And I've been looking at deals for a very long time. And we've got very sophisticated networks that we deal with. And what we have been finding is that a constant stream of deals, but there is simply just a disconnect between the sellers and the buyers. The main reason for that is that everybody thought that the interest rates are going to lower in Q4 of last year. And we saw a little bit of an uptick in terms of the potential of deals, but then it was snubbed because of the uncertainty that's currently happening in the United States. So from that perspective, we found the deals, but the deals are very much core deals. They're down, as we call it, in a 6.5 cap range, which means that the capitalization rate of those deals are that low. And if your interest rate that you get for your senior debt is at the same level, then you actually got negative or no leverage. And we really need a deal that is in the region of 7.5 to 8% capitalization rate for that differential. Otherwise, the deal will produce some cash flow, but not give you IRR. We also found that there is 1 or 2 abnormalities. We had 1 or 2 deals that could come close. We see that there is a lot of rollover in terms of debt. And so we have seen 1 or 2 opportunities where the debt maturity moved the interest rate from 3% to 5 or even 6% now. And then sometimes the sellers are coming to the market. And then when they do, there's fierce competition for them because the amount or the volume of deals that's coming through is much lower. So as a result of that, we have always been, while we're looking in the market, we have always kept an eye on other asset classes. I think most notably, we obviously had a look at the office class, which had a major downturn as a result of COVID, etc. We've seen the hospitality industry really got smacked also in that regard. Same with retail. But the 2 sectors that we have been looking at has been self-storage and industrial. They have been stubbornly consistent. And we have found that there is definitely room for deals that is a little bit smaller deals, but also deals that gives us opportunity to actually achieve the 7.5, maybe even 8 cap range. We found that some of the deals are with less sophisticated sellers, meaning that it's almost a private ownership and not so much the big conglomerates. Obviously, if you go into bigger size, huge warehousing type of industrial blocks, that's completely different. But in the range that we've been looking at, there is really abnormalities in the market, which I think we can capitalize on. And then I think the real attractiveness for us is that we have seen that we've been quite successful in releasing our medical buildings, but it always comes at the cost of a large TI funding. And to our surprise, when we started to look at this, we've seen that the TI relative to the actual leases that you can in a multiflex space, we'll speak about that, is not that high and is not that capital intensive. So it just changes the dynamics, especially if you want to keep the asset for a longer time. So the whole quantum or absolute value of tenant installation relative to the actual capital outlay is just much less, but you still can get the return. So from that perspective, very interesting sector that we discovered now through our partners like Ron and Mark, and me and Martin has really worked through our network. We're actually surprised to how many people are actually do invest in real estate. Industrial real estate is actually a sector much larger than the medical center sector, as we discovered. So yeah, very interesting last 6 months.
Thanks, Machiel. Yeah, let's move straight to you, Mark. You corrected me just now and reinforced the fact that you've spent 40 years in the industrial sector. So perhaps you can talk to us a little bit about how you got into it and how you spent most of your career in this particular real estate sector. And yeah, how did you end up in the segment?
Sure. So Ron and I both grew up in the New York area. Next to New York, physically next to New York, is the great state of New Jersey. New Jersey is sort of a central corridor. It started out as a very large manufacturing sector, both for the garment industry and chemical industry and pharmaceutical industry. Given its proximity both to New York City, it's halfway between New York City and Philadelphia, halfway between Boston and Washington, D.C. Basically, it sits within a day's drive of probably over a third to 50% of the U.S. population. So New Jersey was a very vibrant area for manufacturing. I got my start working for a developer in New Jersey of industrial buildings. And at that time, industrial was really the stepchild of the real estate world. It wasn't as sexy as it is today. It wasn't as attractive as an investment opportunity. But what I loved about it was the fact that I could walk into the buildings and see these things getting built. And that to me really was beautiful, to watch the machinery, to watch how stuff gets done. And that was almost 40 years ago, but that's how I got my start in real estate. And I've been working in that industry since to today. Not necessarily in New Jersey, but we've expanded all over to the United States. We have a large project out on the West Coast. We have stuff in the Midwest. But basically got my start working in New Jersey. Now, with that, there's been a lot of ups and downs in the manufacturing sector, and a lot has played into with where certain treaties have been entered into by the United States, with such as NAFTA, which had a big effect on the manufacturing sector in the United States. And what we're seeing is basically the counter to that right now, is how do we bring manufacturing jobs back to the United States after that big drop of manufacturing that frankly allowed Canada, allowed Mexico to grow, but it's at the detriment to the United States.
I'm going to absolutely bring you back. Yeah, I'm going to absolutely bring you back to that, Mark, because we're going to talk about the trillions of dollars that's being pledged for manufacturing within the US. But perhaps, Ron, you can tell us about some of these mega projects. You guys are busy with, or you completed the project in Washington State. I believe it was the old Hewlett-Packard campus. Perhaps tell us a little bit about that, because that's super sexy.
Well, yeah, listen, I'm happy to tell you guys about some of our projects, but I want to make sure that everybody understands the reason why that we're so enthused about industrial real estate. And I also want to point out something that is not very apparent. And every time you do a business, a lot of business owners, there's a lot of nuances to your business. And there's probably a lot of business owners on this call. One of the things that's great about Mark, aside from the fact that we've been childhood friends, is Mark is very, very technically oriented when it comes to industrial real estate. The other day, Machiel went out with Mark and he went to the Midwest and he looked at a facility. He probably heard Mark talking about the HVAC systems, the electrical systems, how they're distributed, the HVAC, you know, how proper they are, foundationally, roofing, and so on and so forth. And so while I take care of marketing, getting deals done and getting closings done and the numbers, because I'm a CPA by background, Mark handles a lot of the innuendos of the industrial real estate. And so everybody understands when we buy a piece of real estate, we don't look at it in a vacuum. We wonder if we have one tenant or two tenants, can it be divided into 2 spaces or 4 spaces? How is the electrical distributed? How old is the roof and when will we have to put in additional CapEx? How is the HVAC distributed throughout the facility? And these are a lot of things that Mark considers and I've learned from Mark, quite frankly. In terms of industrial real estate, why we like it and why hopefully everybody on this phone call will like it, it's unique, right? It's unique in the sense that there's barriers to entry. In the United States, it costs X dollars to build a new facility, but that's not the only problem. The problem is that bringing utilities, getting governmental approvals, those are very, very tough barriers to entry right now. And it's one of the reasons we love industrial real estate. The second reason is that when you find an industrial real estate with a manufacturing tenant, those tenants are very sticky. And the gentleman here talked about TIs and bringing in new medical tenants, but industrial is a little bit different. If you think about an industrial space with laser cutters and big pieces of machinery, it's not that easy to move. It's very costly to transfer this asset to another asset. The other thing is that it's a simplified operation. Generally speaking, we buy facilities with 1 or 2 tenants. So for us, the opportunity is we have lower management fees, which translates into better returns for our investors. And thirdly, what we're seeing is we are seeing some onshoring. And Mark and I own a facility that's 180 acres out in Vancouver, Washington. It used to be a Hewlett-Packard campus. Well, guess what? We get to see it firsthand. We have a company from China that just took 150,000 square feet. We have another company that just took about 40 or 50,000 square feet, both manufacturing companies and both somewhat fearful of the tariffs and the uncertainty with respect to the United States. So, you know, all of these things, this barriers to entry, the lack of utilities, the fact that it's hard to move, the fact that, you know, tariffs are creating some confusion for manufacturers, really creates a unique scenario to buy industrial real estate. And we think that's going to be the case over the next 5 or 10 years. And that's basically, hopefully it gives you a little background on why we continue to be enthused.
Justin, before you jump in with your next question, I think a pertinent question is, Ron, how many square feet did you end up leasing up in that entire campus?
It was 700,000 square feet. It was about 150,000 was leased. Now we have about 600,000 leased. So we've done a really good job over the last couple of years through a combination of marketing and yeah, so on and so pretty much leased up. Yeah.
Can you give us any indication of the numbers? I mean, everyone on the call here is interested in the numbers. Did you guys make any money? Is there any money to be made in that building?
Well, I'm heading out there this afternoon because I'm meeting a lender on Friday. So yeah, I mean, look, it's on paper, it's been a tremendous investment. It came with some additional land. We went through the land use process, got the whole area rezoned. And again, it was a donut hole surrounded by entire development. So we got approvals to build 1,800 apartments. We got approvals to build about another 1 million square feet of commercial space, industrial space. Now that we're almost fully leased on our industrial space, it makes sense to go vertical on a spec industrial building. And that, which is unique component, because one of the things that we're also saying on this call is that there is a barrier to entry. Construction pricing is outrageously high. And what industrial companies can afford to pay is in a limited bandwidth. So when you look at construction pricing and what kind of returns investors need on that construction, in most parts of this country, it doesn't make sense to build manufacturing properties unless you're building them for Fortune 100, Fortune 500 companies. The mid-sized companies, which are the bulk of the US economy, have to go into existing buildings, which is what we buy. We buy existing manufacturing buildings that have that built-in infrastructure of electric, have that built-in infrastructure of water, are in areas that have skilled labor. So those are the things, the little nuances that we look for when we look for a transaction. Becomes very difficult, as Ron said, for a company to pick up and move a CNC machine to another location. It's expensive to move. It's got to get recalibrated. All those things take time. It takes a lot of money. So what we do find is we find that these tenants, unless there's purely a big financial reason why they're no longer in business or why they have to move, usually they're very sticky. And one of the things about having Ron as a partner is that with his CPA background, we are very careful about looking at the type of tenants we have and what their financial wherewithal is. Because even though our tenants may not be public Fortune 100 companies, they still may be very vibrant and very successful privately owned companies, but we'll be looking at that as part of that underwriting.
And Martin, regarding, hold on, Justin, Martin did ask a question. The deal in Vancouver, Washington that we leased up is incredibly profitable, and it's quote unquote for everybody, it's our blockbuster deal. So yeah, it's
Grand slam.
Yeah, it's a grand slam. I mean, we do singles and doubles, right? Like everybody else, any investor or business owner or professional, but that was our grand slam.
Yeah, it's a pity we didn't know you at that stage, so we could have taken a piece of it. But I think let's just double click on the sector, because I think people are saying, whoa, that's probably going to be above our sort of check size. Industrial is a huge category, and I remember, guys, we used to talk about medical being a huge category because coming from our little part of the world, 27,000 odd medical buildings we thought was huge, but in fact it's actually a very, very small niche. I know that Machiel and Martin want to jump in here because they go to the Revista conferences and they saw them from 150 people to 500 people just absolutely mushroom as more and more people came into the sector. Anyway, obviously there's many subcategories, and buildings that we've been looking at together are certainly not the big box stuff like Vancouver. So perhaps you can just talk to us a little bit about the subcategories, heavy manufacturing, the self-storage, logistics, cold storage.
Yeah.
What you guys like to do, and then the sector.
Sure. So as Justin, as you pointed out, there are many different sectors to the industrial sector, or many different subsectors. They're the well of the buildings, the Amazon distribution centers, the logistic e-commerce buildings. Those are the buildings we stay away from, because basically, in my mind, those are four walls and a roof. As long as you're well located and you have a tenant in there, that's great. But the institutions chase those deals ad infinitum. So those deals tend to go at a very, very low cap rate. And as a result, it's not of interest to us because we don't want to compete at that level. I'm not interested in buying a $100 million single tenant Amazon distribution center, because there are going to be 10 other companies that can buy it before me. I'm more interested in those deals that operate below the radar screen, that are out of the purview of those large institutional buyers, where you start having the entrepreneurs like Ron and myself and like you guys take a look at. So those deals tend to be anywhere below 20 million on an acquisition side. And those deals in terms of sector tend to be manufacturing. Manufacturing has a lot more complications than a straight Amazon warehouse. We have to, as Ron pointed out, we have to look at the roof. We have to look at air conditioning systems. We have to look at structural systems. One of the most important things and first things we look at are environmentals. How clean is the building? These buildings tend to have a history. They haven't been new. These are not new buildings. These buildings may have been constructed in the 70s, 80s, and 90s. So we're looking at various different components that make up these type of manufacturing buildings. So what's important to us, again, on the manufacturing, and again, that's one sector, part of the sector. The other part is light industrial. So we tend to view that at New Blueprint altogether: light industrial, manufacturing, and flex. Those are the three different components that we look at.
Why don't we tell everybody a little bit about what we look for in our sites? Dock doors, access to
Ceiling heights, dock doors, proximity to transportation, proximity to labor. So again, let me go through that. So these are your typical manufacturing buildings where you may have equipment, you may have a single tenant or a couple of tenants. They tend to be somewhat larger. Then we have the lighter manufacturing, which are maybe people would take parts from other places and they assemble them together, and they have dock doors for distribution and electrical. Again, we're looking for electrical distribution throughout the facility. And then we have the flex. Flex tends to be sort of like your multifamily of the industrial world, where you have a number of smaller tenants who are there. They may have shared facilities, such as a shared loading dock, or each tenant may have its own loading in the back and office in the front. These tend to be smaller spaces. They may even go down to about 2,500 to 5,000 square feet of square footage for each tenant, and this may be a 100,000 square foot facility. So you may have 20 tenants in one facility. But what we like about that is we have diversity in terms of tenancy. And again, as what's a little different is we don't have a lot of TIs that we have to roll into when there's a rollover in tenant. Most of these people are either in smaller spaces or contractors or light manufacturers. They just like an office in the front and the warehouse in the back, which is how they make their money. So for storage or for light manufacturing.
Would that be defined as flex space? We hear that bandied about.
That's the flex space. Why it's called flex is because you could take two units that are 5,000 square feet, combine it for 10,000 square feet. You can have you're a little bit more flexible on the design of the office. The office is typically in the front, which is about anywhere from 10% to 30% of the total space. And then you'll have the warehouse in the back. So, and then in some high tech areas, you may even have as high as 50% office. But again, most of the tenants are used to the landlord not providing a lot of money in TIs, which is what we like, because the last thing we want is a situation where we have a rollover occurring and we have to spend a lot of money on office space to configure it to a specific tenant, only to have that tenant move out in 5 years and us having to rebuild that office space.
So maybe if I can jump in here, and one of the things that really excited me about the discussions over the last couple of months was this thing about TI and free rent. And so I remember having the discussion with a number of players in the space, including you, Mark, and I said, you know, when a tenant does want to approach you, and for example, the rental in the market was $12 a square, you had a tenant at $8, you can get a real bounce up to 10, but the guy says, you know what, he's prepared to rather go look elsewhere, and you bring in someone at $10. What does it normally take to get that person in versus in other sectors, which, as we know, cost a fortune?
Well, I guess I'm gonna ask the question, Martin. You've just had a lease where they want a month free rent effectively for every year that they sign, and that's pretty much become the norm in healthcare. I guess is that part of the answer?
Well, I mean, Justin, just to give everyone the context, I mean, it's a great tenant. They want to sign an 8-year lease, but they want $50 a square, which means it's nearly $350,000 plus also 1 month for every year, which is 8 months free rent. Not to mention how long it takes to get them into the damn building. And so this is where, you know, in my assessment, our assessment of industrial, I think it's a great question to put to Mark. How does your segment compare to other segments?
You know, I mean, let's be careful, because sometimes I could say, you know, the rent, the TIs are typically, our TI numbers are single digits. They're $5 a square foot, $7 a square foot, but that's all predicated on the size of the space. I mean, obviously, if you have a 5,000 square foot tenant and you need or a 10,000 square foot tenant, and they only have 2,000 square feet of office, you know, you could get to spending, you know, $10 a square foot or $100,000 in TI numbers pretty quickly if it's a good tenant and you know you got a long-term lease. But in the scheme of things, as a ratio of what the rent is, typically that's what I'll look at. You know, I don't want to spend more than 1 year's rent ever on TIs and leasing commissions. So if I'm doing a 5-year deal or 7-year deal, I don't want to have 2/3 of that or 1/3 of that rental period being picked up as an expense item because I had to spend that money in TIs and leasing commissions getting that tenant to come in.
You know, Martin, you might as well say that industrial and medical are two different worlds, in maybe two different universes. As Mark was just saying, sometimes we don't think it's going to be more than $2 to $5 a square foot for TIs. And you mentioned 8 months of free rent on an 8-year lease. Now it's probably a month or 2 or 3.
Obviously, the market variables. I mean, in certain tighter markets, you may not offer any free months. In other markets, for instance, even in Vancouver, we did the 150,000 square foot tenant. We gave them $7.50 a square foot in TIs, and we gave them 4 months of free rent. But that's a 7-year deal, and they're paying a big number per square foot. So they're going in paying about $15 a square foot.
And I think
give you some ratios.
I think the important thing which we must just mention is that, you know, one of the things that we've spoken about at length is that the attractiveness of industrial is that given the fact that it's essentially a square box, if someone leaves, you know, it's got so many multiple applications that can go into that space versus, for example, in our current portfolio, medical's medical. You've got to find the right medical, and it's only medical over there. Mark, as you were saying, is as long as you find somebody who is in your network or strong, or that your rentals are below market, you have a very appealing proposition if you get it at the right price to bring them in pretty quickly and get that cash flow going again, which is what most of our investors are seeking.
So Martin, you know, you're bringing up a point I wanted to mention, that, you know, when you're buying industrial real estate, and we are very, very careful about what we do in terms of diligence, but your point is well taken, because what you don't do is you don't buy a piece of real estate in the middle of somewhere that it's very hard to get to. So what we're always concerned about is the buy price, and we're concerned about what if our current tenant vacates. So we want to make sure, again, that it's in a geographically dense area, not in the middle of nowhere. We want to make sure that the next tenant understands that he has access to the interstate, that he has enough utility distribution in the building, that if we wanted two tenants, like you said, we have a square box, we'll split it down the middle and figure out how to accommodate potential tenants. Machiel put out a chat before, he said about cold storage. We don't do cold storage because we don't want to be in a niche. We want the flexibility in an industrial building in a densely populated area, that if we lose a tenant, that we can maneuver and have some flexibility with respect to what comes next.
We also want cheap carry. So cold storage is interesting that you bring that up, because to me, cold storage has very specific construction constraints in terms of, especially freezer space, and what you have to do with it, how you have to maintain it, especially when it gets vacant. So we want to be in the most utilitarian type of building that's industrial, to gather and be more attractive to the widest variety of users. So that's sort of our mindset, whether it's flex, whether it's single tenant, light manufacturing assembly, whether it's heavier manufacturing type of buildings.
I think the one thing that I picked up, which I had to really get my mind around, is the fact that we've seen some very, very strong tenants that's a single tenant in a building, versus to what we pretty much used to, always having multiple tenants and ensuring that we can ride through a problem. So how do you deal with single tenants that looks pretty attractive at the beginning, but you know, something can go wrong? How do you deal with a building that you really, really like, you like the tenant, but they're still a single tenant, and we always pose a risk, you know, what happens if? So how do you approach that question?
Oh, I mean, I think in the future, we're going to send Martin in to make sure that the tenant doesn't occupy the space anymore now that we're involved with you guys. All right. But generally speaking, there's not a whole lot you can do other than to make sure that you're buying the facility in the right location, with the right ceiling heights, with the right utilities, that it's going to be a superior facility for the next tenant. And, you know, Mark says, you know, I'm a CPA, but I can't even do my own taxes. But putting that aside, what we do is we do a strong analysis of the company that's there, and you kind of sort of hope for the best. One of the ways that I like to look at financials, everybody, is I like to look at the trends, a downtrend or an uptrend, or revenue-wise and profitability-wise. So what Mark and I are looking for is good trends, uptrends in the company, right? Because that's indicative of where they're going. If we see a downtrend, then the most likely we're going to pass. We've passed on many deals because we didn't like the underlying financials. So, Machiel, all we can do is do our due diligence as of today, look at the trends where they were, and make sure we're buying a facility that, if God forbid something happens, that we have the potential to lease out with not a lot of angst.
Well, you know, that's a good point. And maybe I can ask the question that, you know, sometimes in our particular niche, we're not able to get full financials from the tenants. Would you do a deal if you don't have financials?
We would be very, it depends. First of all, it depends on the deal. Obviously, a multi-tenant building, we may not get the financials for every tenant, but for a single tenant building, we would be hard pressed if we didn't have some idea, privately owned company, we have no idea about performance. We would be hard pressed to do that deal. It would really have to have a compelling story. Either the rents would have to be way below market, in which case we're kind of hoping that they crap out, that they move out, or that we think there's such growth in the market in terms of rents, in terms of location. But there would really have to be a very compelling story.
Let everybody, you know, let me just put this out there for everybody. If it's a single tenant, like Mark said, it's almost impossible to do a deal without the financials, because we have the banks, right? We're getting third-party money. The other thing is we guarantee the loans. So if anybody here, and I hope everybody here works with us, and we're pleased to have everybody and thrilled to have you on this call. But if you decide to work with us, understand our money is in every transaction, and we pretty much guarantee every one of the transactions with the bank. So not getting a financial statement is probably bad business and probably not doable in many respects.
And then in terms of rental, you know, I just want to also mention that in terms of upside on the deal, you know, the one thing we've seen in, you know, other classes, and I'll talk again about medical because that's where we come from, is when you lose a tenant, generally, if the person was paying $25 a square, you'll probably reset a new tenant at maximum 25, if not go back to 22 and start to build up again, you know, which was fascinating when we came across really looking at the bulk of industrial deals, where the target is actually to find, as I said, for example, if the market is 10 and a guy's paying 6, you actually, in a way, almost don't mind if the tenant leaves, if it's in a good location, because you can get that massive bounce in your income, which gives you an immediate 20% growth in the value of the property. And so that's something we spoke about. You know, in terms of your actual deals, how do you model going into transactions kind of upside? Because I know you look at singles and doubles, but what is the kind of upside you look in these transactions?
So what we're looking for are both, you know, again, what we're buying in these tenants are effectively annuities. We're looking for stability in tenancies, and then long-term, we're looking for where the rent growth is compared to market, and how vibrant that market is. As Ron said, we don't want to buy real estate in the middle of nowhere. We want to make sure that trending rents are always higher than what our rents are contractually in the lease, so that, God forbid, the tenant does go out in 3 years or 5 years, or at the end of the lease they move out, we are at a point where we will below market. I never want to be in a situation where I have to mark to market or rent down to release it. That is the last place I ever want to be. So I always want to be below market on our rents. It's one of the first things we look at in every deal of where our rents are compared to other markets. And we do a lot of due diligence in making sure that our rents are below market. So it's not necessarily something you ever see in the returns necessarily, because if the tenants stay, you don't really get to see those bumps. But what you do is you get stability of income and a good stability of good income. So, and if they do crap out, well, we know we got to carry the building for a while. That's always modeled into our numbers. We hold back reserves to cover those carry costs and leasing commissions. And then hopefully we get that mark to market bump, that increase in rents.
I just want to add to, to what Mark said. Martin, you talk about underwriting. One of the things that we do is we take a conservative view of our underwriting. And so we mimic what if a tenant leaves? How does that affect our returns to our investors? What cap rate do we exit out at? And we do that conservatively. What type of leverage do we use? Everything is really conservative. Now, Mark and I have recently done two interesting deals. One was in Brown Deer in Wisconsin, and we bought a deal for $8 million, and we knew ahead of time, obviously, but we're very fortunate because what happens in industrial real estate sometimes is some of the upside is not borne by the seller, but by professionals, real estate investors. So for instance, in Brown Deer, we got 5 extra acres, and now we're going to build apartments on there. Guess what? That 5 acres was worth $1 million that we didn't pay for. So as opposed to maybe medical office, which may not have extra land and construction may be an issue, there's a case like that. We've had 2 deals recently that were very similar where we had extra acres adding to the value, but we didn't underwrite it. We didn't put it in our model. The model has to stand on the basics.
Has to stand on, each deal has to stand on its own of what we see in there today.
So Justin, I think one of the things that really excites me and Machiel, now that we, really investing heavily our time and effort into this niche, is tomorrow Ron and I are going to see a particular building that is way below market, long lease, ticks all the boxes. But the most important thing for me is the seller. I'm so tired of having to deal with large institutions and 10 lawyers and all the bureaucracy. And given the fact that the market is so gigantic, and I ask everyone just to think of your own little area, how many medical office buildings, which are great in your area, versus how many industrial buildings. It's quantumly bigger. But the point being that these industrial buildings are very often unsophisticated sellers. In fact, one of the deals that we were looking at, the person didn't even have a lawyer. He was like, well, okay, let's just talk about this and maybe I'll get someone to have a look at it. So, one of the stories that really interested me was in the US, a lot of people have, just so everyone understands, a business, they own the building, the parents unfortunately sell the building or pass on, and the kids that have now got this asset worth $5-6 million, they're not in real estate, and they just want to get rid of it. They're thinking about where they're going to have a retirement property and their next car they're going to buy. So I find that very appealing in terms of being able to do very creative deals as opposed to dealing with the usual large REITs. Mark and Ron, what is your experience based on what I just said?
You hit the nail on the head. Where there's lack of clarity and things like that, there is opportunity. And that's why, Martin, you were right. When we bought Brown Deer, the seller it's a storage company, 3rd generation. He never thought about what he could do with it. If he would have split the 5 acres and sold that off, he would have gotten $1 million. But he didn't do it. So we bought everything for $8 million, including the land. So there's this unsophistication, and that's okay. Maybe they just don't want to deal with it. But what it does is for me, Mark, and your team, and everybody on this call, there are unique opportunities. The breadth of the market is big, and the opportunity is there, as you just said.
Guys, I'm gonna jump in here. Questions, please. We are running out of time, so drop your questions into the Q&A. Here's your opportunity. Thank you. We've got one. Jumping into the opportunity, you can ask Mark and Ron directly any question that you have about industrial. I see a question. I'm going to move to it straight away, seeing as we are on the topic.
That's a good question.
Dave is saying, Martin, you're ultimately saying that medical is a flop.
No,
That's straight
not
up.
at all. Absolutely not. In fact, medical, as I said, I just want to reiterate that medical is a great sector. The challenge is that it's proven to be such a great sector that you now have, as Justin mentioned, we used to go to Revista, there were 100 people. There's now 500 people in the room, and every single large player in America all competing. So, it is still highly, highly competitive. And make no mistake, if the large players could buy up another 10x of deals, they would. But we're just seeing now that the opportunity exists almost back to when we started. When we started, we were buying deals with a margin of approximately 1.5% between what you're buying as your cap rate and your debt. So Machiel explained it earlier. So for example, right now, if your debt is around 6% and you can buy at a 7.5%, you've got a built-in margin on day one and a very solid return. And so off the back of that, I want to ask Mark and Ron, your two LOIs, your letters of intent that you've just signed right now, just give everyone an indication of what cap rate you got those incredible deals at. And this is like in the last month, right in our sweet spot.
We're buying it over an 8 cap, and we're going to probably borrow at a 6.4. So for everybody on the call, we have a tremendous spread here. And we're getting our 2-3% rate of increase in our leases. We're paying down our mortgage, and what we ultimately think, everybody, is that interest rates are going to come down. And for all of us on this call, that's going to be a huge benefit on the upside. I also want to say, Dave, one of the things Dave asked the question, Martin, medical buildings, everybody piled in, as Martin said. People are less likely to pile into industrial because it's not as pretty. You can buy a medical office building that looks great. It's got a great facade. It's got wonderful doctors, but so what? Okay, maybe back then when there wasn't as many players, but today industrial is a little bit more of the ugly duckling. So you have to have a real sense of what works and what doesn't work. And that's where you sort of zig and zag in business.
And I'm going to bring Machiel in here for a second, because this is really, really good. This cap rate discussion, I think, answers your question, Dave. And Machiel, you just sold 2 buildings. What was the cap rate for those 2 buildings that you sold at?
Yeah, we achieved 6.7 in those deals, and the other one we achieved 6.8. So just below 7 we achieved on those deals for deals that's basically got an 8-year WALT and around about 95% occupied.
Yeah, but I think the point is that your cost of capital, in other words, your cost of debt.
Yeah, the cost of debt, we on that specific deals, we got that cost of debt down just below 6.8. So we basically sold it at cost of debt. And the reason why this institutional buyer can buy it is they have their cost of capital, as far as I'm concerned, is low, because they actually buy it with equity instead of spending money on interest to the bank. So I think also just a question back to, or answer to the guy that answered or asked the question, is that the comparison between medical and industrial, in my view, is that they are both sticky, extremely sticky. And we've seen specifically in the COVID situation how good the medical held up. And I think it's just a different time in the market cycle. So from my perspective, Mark and Ron, how did you experience COVID during that time? And then where do you believe the market cycle in industrial is now in terms of cap rate movement?
So
Either one.
Well, as I tell you, for COVID, I had a high fever and my stomach hurt, if that's what you're asking. But in terms of cap rates, I mean, I think we're where we want to be, right? Because I think the interest rates have been going up over the last 3-4 years. The Fed held them down for too long, right? We were at 1 or 2%. Now they're up, and now you see the U.S. is sort of teetering on a recession. So the next year, 2 years is really a great opportunity to buy at 8 caps and above, and then hopefully down the road exit out when the rates sort of dip. And I think that's the biggest mover of absolute dollars and returns on real estate.
Questions from the floor, guys. Coming from Chaim. Is it a lengthy process to evict a tenant who has not met his commitments? Is it expensive?
Yeah, I mean, two of you asked about the equipment. So first of all, it's very market dependent on each municipality, depending on how long the eviction process takes out. But again, most of these tenants, this is not their home. This is a business.
Yeah.
Most courts have very little patience to deal with tenants who don't pay rent on a commercial basis. So these are not small storefronts. These tend to be, mid-sized businesses. Most court, even on the smaller businesses, most courts don't have patience for this. So they tend to get done in less than 6 months. But again, that'll vary depending on which municipality the building is located in. In terms of equipment, that's a really interesting question to Lon and I, because we used to be in the business. Part of the corollary business was to buy these buildings with the equipment in hand, because we figured out, or the people we worked with at the time figured out, that there is a great way to make money by selling equipment. So one of the educations that we got is that we got to learn who were the best agents, auctioneers, dealers for specific types of equipment across the country. So in some cases, you kind of hope, hey, maybe it won't be such a bad thing if this tenant craps out. At least we know there's tremendous value in that equipment and how to get rid of it. The most important thing we learned through that process is how to get rid of it and not destroy our building, which is really a nuance in terms of managing a terrible situation like that. But I'm not at the end of the day, we know how to get rid of equipment.
Yeah, I was going to say, we came from an equipment liquidation firm that bought equipment, and we bought the equipment and the real estate. And what we were doing was liquidating the equipment. So I saw Chaim put that to the answer to question to us. And he's asking because it costs a lot of money to move this equipment, but we wouldn't do that. What we would typically do is we do an in-place auction to auction off the equipment, and the buyers would have to take it out. So Chaim, that's how we mitigate that issue.
And the stuff that's left behind is typically metal, and you would get what's called a scrapper just to come in and collect the scrap metal. And usually it doesn't end up costing the owner anything other than the 1 to 2 months it takes to remove that equipment. And again, that's in a situation where the equipment has still been left behind. Typically it doesn't happen, but sometimes it does. And that would be our method to getting rid of it.
So how many industrial commercial real estate do you operate? I guess with your portfolio and our portfolio, we operate about 10 different facilities right now. And we probably have about 25 different tenants.
In terms of square footage, it's over probably about 1.2 million square feet, if that's a number that's meaningful.
And so, Michael, you asked about tariffs, and that's a really, really good point. So in our due diligence process, that's one of the things that Mark and I always look at in terms of what the company does. You have to remember, we're not just looking at real estate. That's a big part of it, but we're also looking at the tenant. We're buying the tenant. If we believe that in some way, shape, or form, the tenant's going to be affected by what's going on with the tariff situation, then it's probably a hard no for us.
Or even the market, as Ron's saying. I mean, even we were looking at a beautiful industrial building that had a home goods company in there, where they were manufacturing home goods. Now, we know the way that sector has been operating post-COVID, it's been terrible. Even though we loved the building, we hated the business. So it wasn't a deal we did. Additionally, one of the other important points, the whole tariff situation and the volatility of it has created a lot of unknowns. So as Ron said, we really are right now being very careful about what sector and how each business is in terms of underwriting, not only the building, but underwriting the business. We'll see where that could change in 90 days. I mean, one of the things when Trump came into office, he said he's going to have 90 tariff agreements done in 90 days. He's gotten 2 done. But, look, I mean, he's just delayed another set of tariffs of coming into place. So maybe carrying a big stick and threatening them may be enough to bring some of the other countries' counterparties to the table. And in the long run, none of these economic movements happen so quickly, but they can have tremendous impact quickly, but the resolution may take much longer.
The bottom line is it's part of our due diligence, Michael.
Yeah.
It's really part of our due diligence. We want to make sure that the guy's not importing 100% of his stuff from China, and he's going to be affected for sure. So we're with you on that. And Kurt, that's a great, I don't know, Justin, but Kurt wrote this really great comment. He definitely understands the parallels between the US market and the South African market. Except the US market, Kurt, is so big and broad that it's fun to play in this playground. So we definitely look forward to working with you on this.
But I think also if I can just mention, Justin, about the pricing, we haven't spoken about price per square. We touched on it, where buildings are now anywhere from 300 to 400 to construct. I mean, we're looking at buildings at the moment right now around about $100 a square foot, and well below market. So you can see already that's the one side just in terms of purchasing. But the other big tailwind behind is the sentiment across the entire US at the moment that the pressure being brought on the Fed to reduce interest rates, saying they're holding back too long, is just ratcheting up every single month. So even if you look at the 10-year yields, not from us, it's the Fed's projections and everyone else's, that rates are coming down. It's like all the real estate players are sitting on the sidelines and saying, we better jump in. Because the moment the rates go down by even a quarter basis points, 1, 2, or 3, so cap rates follow it straight away because your debt just got cheaper. And so that's the reason why a lot of people have been saying specifically at the conferences, it's a buying opportunity now. It's the time to climb in now. And hence the reason why we are now going to be actively back in the market. As I said, medical is difficult to find deals. The good news is in the industrial sector, we believe there's enough deals to easily compile and build a solid portfolio that can probably, in my opinion, produce more cash on cash than we have. The other thing is, in terms of my last point, is the aggregation of a portfolio. Your view, Ron and Mark, to be able to get enough deals to put together a nice, exciting portfolio as strategy. What are your thoughts on that?
JP Morgan just purchased an industrial portfolio of scattered industrial properties. The portfolio size wasn't even that large. It was 150 million. So there's a real push for the institutions to buy in this sector. The problem that they have is that they don't have the bandwidth to buy assets that are priced below, let's say, 10 to 15 million. It takes them a tremendous amount of effort to do deals that size. But when you can aggregate them to a portfolio of 10 times that amount, it starts being very attractive to them. So in theory, that would be part of our goal, is to create that portfolio of that size, turn around, be able to sell it to one of those larger institutional buyers whose cost of capital is significantly cheaper than ours, and then start doing that again.
So for everybody on this call, think of it this way. We are, as many of you probably built your own businesses, that's what we're doing here. And we hope that you come along for the ride, but we're going to buy deal after deal. We'll put together 10 or 15 or 20 properties. Hopefully you're in on some of those. And then what we'll do is, in one fell swoop, we will sell it to the Blackstones of the world, who must buy those size, because they can't buy the $5, $10, $15 million deals that we're doing. So we are essentially putting a portfolio together, as Martin and Justin are saying. And what we're getting for that is we're getting cap rate compression, right? They're going to pay more for a portfolio like that than they would for one asset. So this is the ride we hope that we are taking.
It's a variety of things. So we get cap rate compression. Our rents are naturally ratcheting up with each year based upon the contractual rents in each lease. And then additionally, we're paying down the mortgage. All of our mortgages are amortizing.
Justin, do you want me to answer some of these questions up here while we?
I was going to say, guys, let's try. We try and stick to an hour, and obviously we got a bit of your time, guys. So thanks for that. You're running over your hour, but let's just hot pick a question or two and answer them.
I'm going to just jump in quickly. Sorry about that. I think an important question for our investor, Deanna, is that we are definitely learning from experienced players, and that's why we're bringing experienced players on to help us avoid any school fees. So one of our key strategies is to partner with very experienced persons. And as you could see, Mark and Ron, we joked about I want to say centuries, but the decades that they are in the industrial unit. So we're definitely going to shortcut the school fees so that we don't have to deal with that.
Time, 3 to 5 years, maybe more, maybe less. Just depends on what happens with interest rates, quite frankly. Then someone asked about vacancies. What Justin, Martin, Machiel, me, and Mark are doing is we're buying actually in areas where the vacancy rates are fairly low. And what that means is anywhere between 2 and 4% vacancies. So that answers that particular question.
Someone also asked the question about the exit strategy. You know, the wonderful thing is that in this particular strategy, if we've bought a building, created some value, and a buyer comes in immediately, or we're able to flip it and bed down that actual profit, we will do so in the portfolio. So even though it might be 3 to 5 years, if we can sell assets along the way and with capital immediately plus a profit, that's what we'll be doing.
I agree with that.
Yeah. And I will answer your question. How does this fit into our Accretiv plan to build a medical portfolio and sell? Well, I think that we have a fantastic medical portfolio, close to $200 million. As Martin said, performing pretty well on its own. Only thing is, obviously, the cost of capital. Interest rates come down, cap rates compress. We will be absolutely in the market to sell that portfolio. And a buyer of that portfolio doesn't want to buy a mixed portfolio with some industrial buildings in it. Hence the reason why we are going to launch another little fund. And people have asked us what happens after medical. It's Accretiv hybrid in the Seychelles. And of course, that's where we will do our holding company once again. And we have already identified a couple of buildings. And I think Ron and Martin are traveling around doing some diligence on a few of the buildings. Perhaps you want to just talk about those quickly, Ron. What are you going to look at in the next couple of days?
Martin, do you want me to respond to that?
No, absolutely. I'll just give the intro. And before I forget, I just want to mention it's wonderful to see someone say that they're in Vietnam currently in their hotel listening to the webinar. So we genuinely hear.
I love that answer.
But you know, we've done a lot of work already. We've taken a huge amount of deals in a funnel. We've narrowed it down to 2. You'll be hearing about it hopefully very soon. And Ron and I are actually off tomorrow to look at one of the buildings. Ron, you want to tell them, just give them a little teaser about it?
Yeah, I mean, it's really one of those bread and butter buildings. You know, it's got good access in terms of dock doors. It sits in a high density area right off the main street. It's got a tenant that's been there for a number of years and has another, I think, 10 or 15 years left on its lease. And it's central to what they do in that area. So it's important to the tenant. It sits in a high density area. It sits in an area with vacancies that are below 2 and 3%. And it's priced at over an 8 cap. So we hope that everybody here will see the memorandum and be as thrilled as we are with respect to that deal.
And maybe, Justin, if I can bring Mark in here, because Mark actually went to go see the other building, and you can just give a teaser, Mark, as to the tenure and how long those tenants have been in that building you went to see last week.
So I want to say the owner has owned that building. Machiel and I went to go see a building last week. The owner's owned that building for approximately 13 years. And the tenants, there are 4 tenants in the building. I think they're all pretty over at least 5 years. One tenant in particular
8 years already. Yeah, one is about 8 as well.
Yeah, one of the tenants has expanded. I think this is on they're on their second expansion, TPMS, Machiel, if I remember off the top of my head. So they've already expanded twice. They've invested in machinery and equipment. They do a combination of design and specific contract manufacturing within this space. For their particular industry, we have a pharmaceutical company that's tied with a local hospital chain that's very large in the area. They actually do their compounding medications in this particular facility. And unfortunately, it's for people who are in hospice care. So they distribute everything out of this facility. And what I love to hear is that they just spent $250,000 on an upgraded HVAC system for their clean room. The tenants spent 250. I think the tenants in maybe about 8,000 square feet. So not a very large tenant, but when you hear a tenant spending 250,000 square feet on HVAC equipment, you know they're going to be there for a long time, especially tied to a hospital chain. So, but the fact that the owners owned it for 13 years, he drove by it every day on his way to work. His office wasn't in the building. He's maintained this building meticulously, from everything from tuck pointing to the garage to the roof, replacing most of the HVAC units. You could see it was a little bit of his pride and joy, but this wasn't his business. He owned a couple of different buildings. He had 29 investors on this deal, and his real business, he was in the traffic management business. So this was sort of a distraction for him, which was the reason why he was selling.
Love these deals with the distraction. You know, the other thing is, one other thing, Justin, I don't know if you know this, but I told Martin and Machiel, we got a call from the broker. The seller got an offer for another $150,000 the other day, and the seller said no. I shook hands with Machiel and Mark, and we're doing a deal. So, you know, one of the other things is Martin and Machiel and me and Mark is acting quickly. These deals are in demand, but you can buy them right if you act fairly quickly and are decisive. Sellers like that. So anyways, they got another offer above our price. It's all good.
So that'll probably be the first deal hopefully we do together.
Fantastic.
Yeah,
And it's still in the 8 cap. It's still in the 8 cap. And to Anne's point, you know, we are determined to put together 3 little deals, certainly before the year ends, that we can close on, that can form the basis of our Accretiv real estate hybrid fund. And so that's the answer to Anne. Guys, we are just over an hour. We will certainly do this again. And I think the next webinar we'll have is probably in 2 weeks' time on industrial. And hopefully we will be able to show you some real deals and some meat. And I'm hoping that Mark and Ron will come back and give us some wisdom. We've got some more questions that have popped in, unfortunately. Let's call it a day. And I'm going to end off just reading Kurt's message here. And, you know, we're in a very small market, guys, on the tip of Africa here. But Kurt writes, everything you've been saying is 100% the same as here in South Africa, where I've been specializing in industrial property for 35 years. People don't find the sector sexy and therefore know very little about it. I made all my money here and I'll be keen to explore the USA market. And then, of course, he follows up by saying he's coming to the USA and he wants to come and meet you guys. So
yeah, we look forward to that. Kurt, if you're still on, we look forward to meeting you.
Yeah.
Fantastic. All right, Martin, any parting comments on your side before we call it a wrap?
Yeah, so I think that we're super excited to be able to bring investors from around the world opportunities, again, that we find tick all the boxes, that are able to generate the required returns, reasonably low risk, stable, consistent dollar dividends with big upside. And importantly, I want to end off on the one thing which we're super excited. We've got our own internal property management division. And I was saying to all our partners, we're going to be going out and we're going to be going to meet the tenant every month like we do on medical. And they were like, well, sorry to tell you that these are industrial guys. They're running their business. They don't want to see you more than once a quarter. So it also comes with the added benefit of not as hectic in terms of property management. So I just want to say to everyone, thank you so much from around the world for joining us tonight. And we look forward to bringing you the first couple of deals and adding to our portfolio that we already have, but just in a different niche. Thank you very much.
Thanks, everyone.
Thank you.
It's a wrap.
Thanks, everybody.
Thank you.
Yeah, bye-bye.